So, good afternoon. Shall we start?
Yeah, Devroop, over to you.
So, good afternoon to the esteemed panel of experts and the audience today, and a very warm welcome to the ASSOCHAM Roundtable Discussion on Startup Exit and Acquisition Strategy. And this is part of the larger ASSOCHAM Startup Launchpad, which is going on, the discussions which we have seen over a period of time. Today, we have a panel of experts who represent stakeholders across the whole ecosystem, the startup ecosystem. We have representatives from Government of India, we have startup founders, we have investors, we have senior industry leaders who are mentoring startups or who are part of the startup board. And we have people who have seen the startup ecosystem in India as well as abroad. The aim today that we have is to look at the exit and acquisition strategy for a startup from a holistic perspective, from the perspective and lens of various stakeholders, and to understand what is a exit strategy, why is it important, at what point of time should a founder think about it, what are the various options that a founder has, and how do you make it successful, and so on. As a format for today's roundtable, we would have initial thoughts and points from our speakers on the subject of the day. This would be followed by 2 rounds of moderated discussion as we look at all aspects of the subject. And then finally, if time permits, we would look at questions from the audience. With this, I would like to welcome Mr. Rohit Bhayana, Chairperson, ASSOCHAM Startup Council and co-founder and managing partner of Loomis Partners, for his welcome address. Rohit, over to you.
Thanks, Devroop. Thank you very much. Good afternoon, everyone. On behalf of Neelam Dhawan, my co-chair and I, a very welcome to today's session. It's the final in this series of masterclasses that we're taking up this extremely important topic of startup exits and acquisition strategy. It's been building upon a very carefully curated set of sessions, which were the feedback for which we got about 2 months ago in a session we did with 60 to 70 startups across sectors in various parts of the country. And we went through over the last 5 or 6 panels that have happened. We have covered topics as diverse as raising capital, government interactions and government initiatives, to mentoring. So several of those have happened, and we are now on to this final topic. As a not just in the position as a chairman of the ASSOCHAM Startup Council, but more as an investor myself, I can't overstate how important exits and acquisitions are to the whole life cycle of a startup build out. It's so vital that when you look at the journey and capital coming across various stages, from seed, angel, going all the way to various series, to becoming mature and raising growth capital, all of that is happening because at the end of the day, a very large part of that underwriting is happening on value creation. That value creation translates with liquidity, and that liquidity happens with either an exit or an acquisition. And therefore, whichever way you look at it, the whole purpose why partners in the journey, financial investors who are coming into the journey as partners, their whole purpose of coming along is to be able to partake in that journey. So I'm sure everyone understands this very well, but I think today with the kind of table we have across, we are really looking at some very insightful points coming up, going quite deep. I really think, Devroop, it'll be great because this is a part which, while it's very understood, the nuances are very different. And you have a few questions I saw, which are very, very relevant, which go into the fact that minor changes here and there make the difference between success and not such great success, or success and failure. So I think it's extremely important that we keep enough time for allowing a free-flowing set of questions. If we can, as a group, accelerate, I'm sure there will be many questions, and it'll be great to see us having the ability to take as many as possible. So with that, I open the session and I hand it over back to you, Devroop, to take us through. And thanks, Devroop, for moderating it for all of us.
Thanks, Rohit, for your opening remarks. During the course of the day, we would have Mr. Jeet Vijayvargi, who is the CEO of Meeti Startup Hub, joining us. He had to move for an important meeting, but we'll come back to him once he joins at a later point of time. With this, I'll go to Mr. Saurabh Gupta, co-founder and CEO of VerySmart. Saurabh, for your initial thoughts that you may have.
As being pointed that every company has their life cycle for growth and expansion. Okay, so in that life cycle, the point where we really need to focus, our founder really need to see that whether the growth has been saturated under his leadership. Second important point is that whether the company is ready for a next level of scale, or the team is capable enough to scale to the next level itself. So that is another point which adds up, and also you got the sufficient capital in hand to splurge on that particular grounds. Fourth important point which I feel is that sometimes there are the visions or the area which a founder was not being able to churn, like they are not able to quantify whether this is the area where there can be a possible application or possible use case for the masses for that product, which are being there, which comes with a deeper partnerships with a corporate or a corporate giants itself. So that is that are, I think, few of the areas where our startup founder really start looking in to have a exit or not, if not an exit, or get their startup acquired and be ready for a next round of life cycle for the company to grow.
Sure. Thanks, Saurav. Those were very interesting opening comments. With this, I'll move to Mr. Ankush Sabharwal, founder and CEO of Corover Private Limited. Ankush, for your initial comments.
Hey, thank you so much, everyone, for allowing me to talk. Very interesting subject. My name is Ankush Sabharwal, founder and CEO of Corover. We are into conversational AI space. We got 400 million users using the virtual assistants created by us. On this exit and acquisition, see, I'm not fan of exit. As a founder, so if we continue, when we start something, we start with a purpose in mind, with a cause, and mostly that's to solve the problem. And I'm sure in the current age startups, we are picking up the problem which are very, very large, right? Which are scalable. And I don't think we can solve a problem in 2 years, 3 years, 4 years, 5 years. In our decks, I don't have exit strategy. So, I know investors look for exit. I believe in staying in the game and try to solve the problem. And of course, we should pick up the problem which is big enough to solve. If exit was that important, we would not have seen Mukesh Ambani and Facebook and Google and these big companies. And yes, if you think IPO as an exit, of course, IPO is definitely a road to, if taking money is important. Of course, that's important. Money is kind of bloodline for any company's growth. And on M&A, so I believe in M&A because as a startup, sometimes you definitely need a push. So you are good in solving a problem, and of course, we have to be master in whatever we are doing, and that's why then doors would open up. And if there is a synergy for a bigger company to join hands with you, and if sometimes company acquires you to kill the competition, we have to be very, very careful about it, right? Sometimes we keep getting M&A offers and we say, hey, if we allow us to do whatever we are doing, if we continue to do whatever we are doing, we kind of welcome any M&A kind of offers. And that is only to kind of increase the ecosystem, right? So bigger company comes with a lot of funds, they come with a lot of trust globally, they come with a lot of partners, right? Then you can get a big platform to solve the same problem. But if you're just kind of merging, right, you get some money and you kind of thinking about another startup. So that's something I'm little apprehensive about. But if you continue doing whatever you started with, with bigger umbrella, then why not? Whether your name is going to be retained or not, that is also probably secondary. But now I've seen very good M&As are happening. Bigger companies are allowing startups to retain the same name. So I think now it's very, very healthy environment. So very, very excited to be in this space. And thank you for asking me.
Thanks, Ankush. That was a very interesting and quite different perspective. We'll come back to that at a later point of time during the discussion. So with this, I'll request Ms. Shivangi Bovna, Head for Investment Product at Mumbai Angels Network, to come in and share her initial thoughts for the day.
Sorry, I just had a bit of a technical glitch. Thank you, Devroop, for the kind introduction, and it's indeed a privilege to be part of such a distinguished panel. So I'll actually take a minute to introduce Mumbai Angels Network for those who are unfamiliar with what we do. We're one of the India's leading early stage investing platforms. Today, we was established in 2006, and today the network is over 550 members strong, located in 40 global cities. As of date, we've invested in over 170 portfolio companies, and our companies have seen over 75 exits and next round of investments. From our perspective, when we invest in a company, the first advice we give our network, the investors on our network, is to stay on the cap table of the company for as long as possible. It is good for the wealth creation for both the investors as well as the founders. So what happens is the key challenges that startups face during the initial stages of securing investments is mostly related to the fact that they're too nascent for institutional funding. And this is the gap that platforms such as us fill, where we don't qualify as institutional investors, but we're the first organized capital that comes on the cap table. So as a platform, we look at an asset allocation approach where we ask investors to maybe allocate 4 to 5% of their overall portfolio into this asset class. We're process driven, we're algorithm driven, and most importantly, we focus not only on investing in the best startups in the country, but also on the growth and exits on these investments. As our CEO Nandini Mantika often shares, the investment is actually the courtship period, and the real marriage is on the exit, both for the founder as well as for the investors. So I think as a platform, we play a very, very unique role where we represent both sides of the table, and we ensure that subsequent rounds of fundings and an eventual exit, which we hope is successful, is to the best interest of both parties, the investors and the founders.
Thanks, Shivangi. That was very interesting. With this, I'll call upon Ms. Neelam Dhawan, co-chairperson, ASSOCHAM Startup Council and a tech industry leader, to come and share her initial thoughts. Neelam, over to you.
Thank you, Devroop. This is really a very important topic to discuss, because as I see, most of the startups are looking at either an acquisition or a merger, or as was mentioned by Ankush, looking at selling out their business. It could be even an IPO. And they're all looking at it for different reasons. And it's important to understand the reason. In many of the instances I've seen, the purpose which the company was set up with, the objective which you were thinking it's going to achieve, is somewhere got diluted over time. And hence the founder feels this is the time that I need to exit from this business and focus on something else. And this is perhaps the number one reason I see in the last few months as to why do founders want to exit a business, completely exit it. And as Ankush rightly mentioned, IPO is to raise capital. When you are seeing what can take the company to the next stage, how can I take the company to the next stage? And that's when it comes in to say, if you need capital, how will I raise it? What's my lowest cost of capital? What's the best way to raise it? I don't think every IPO or every change in investors means that the promoters have to leave the business or the founders should leave the business. Let's not look at that as a decision point, because many of the investors stroke even after IPO, people want to see the same founder continuing, because the money has been raised for a purpose. And if that purpose has to be achieved, the founding team should be in place. And hence, it's challenging even to know when should you do the exit, when should you do an IPO, when should you raise capital, when should you go on to another venture. That timing of itself is something which is very difficult sometimes to judge.
Sure. Thanks, Neelam, for your perspective. That was really useful and interesting. So with this, we will move on to a set of moderated questions. The idea is to get perspective of different stakeholders across the whole gamut of questions that a startup founder would have around exit and exit strategy. So starting with Mr. Saurav Gupta. So Saurav, you've been a successful entrepreneur. You have seen your startup venture being acquired by larger corporates. So as an entrepreneur, what do you think is the right time for founders to look at exit and acquisition? From a founder perspective, what's your view on that?
See, right time for a founder to really look into acquisition or exit is totally dependent on multiple factors which are around. Either they have been saturated for a long and not able to take the company or the product to the next level. Okay, they're not able to connect to the masses, which every product is actually aiming for, or the team or the company is aiming for. That is maybe one of the reasons. Second thing is your competition is crushing you too much, where you think, see, we are in a price sensitive market, like especially when we talk about India or any of the Asian countries. These are very price sensitive. Here, a customer is not able to decide every single time whether which product is good or bad, unless until they start using it, they subscribe for it. Okay, so that is one of the case where there's a global competitor which has entered into your space, and you think that if you are not able to do a justification to your product while being into your range, it's better you just pass on that range to a larger corporate who can have a head-on with that other global competitor. That can be one of the other reasons. Third is that the capital requirement for scaling the company to, let's say, being ready for every sort of challenges which is being there. That is, a third set of thing which founders are really focusing on. And fourth is that your product is really has not looked up its entire potential, because you have been focusing narrowly on certain segment or certain sector itself, where a larger tie-up, which may be in the form of an acquisition, could actually result more. So let's say I'll give you a very fresh example. There's a company called Customer, Kustomr. That customer company got acquired by Facebook, and now Customer is a CRM based company. Okay, in a CRM based company, you would see that Facebook wouldn't have a direct synergy altogether. But when Facebook, being social giant, they are putting up different set of businesses across Facebook business, across WhatsApp business, and more. They are going to push all their customer segment, which is more than 240 million people who are doing business through these channels, could take a leverage of that platform as a CRM. So a Customer as a company which got acquired in $1 billion wouldn't have been able to reach that much customer base in a direct growth itself. So that kind of acquisition would really matter a lot for the end consumer, because they are getting directly benefited. They do not need to open up a new channel or sign up to the platform directly. Now their present native platforms are providing that set of services to that particular thing. And that is one of the reasons we have seen more acquisition happening towards the side of SaaS platforms, or the platforms which are natively integrable to other platforms itself, rather than the platform which have a network effect and or as a pass itself. So that is where things are being there. And judging the right time is something each and every individual's call, where they think that they have given whatever they have in terms of experience, in terms of knowledge, in terms of bandwidth to a company, and now they think that someone else, a better leadership can take it to the next level. Many people look at that way. Although founder egos are different in these cases, where they're kind of being reluctant of that decision. But I think it's not about just being a founder running the business. It's about making that product being accessible to the end consumer in a massive way. That is solving the problem. That is the most important focus for a founder to be. So that I think these are the few of the points which helps decide a right time kind of a decision for making an exit or a acquisition for a company.
So thanks, Saurav. That was a very interesting view, practical points as well as practical examples that you brought out. So with this, I'll go to Ankush Sabrawal. So Ankush, as a founder, what are the challenges that you see or you have experienced or you foresee in potential exits, and how does one prepare for it? So Ankush, over to you for your views on it.
Yeah, so disclaimer is we did not go through it kind of completed it fully, but in the process of multiple discussions, and hopefully we'll be announcing in a couple of months. But I learned through the cycle. I think the first, I would not say the challenge, but I think the most important is as a startup, we should be very good at what we are doing. And we should be perfect in what we are doing, right? So that whenever we are on the table, we should not be like, there is a bigger company, a smaller company. There might be bigger company, of course, but they are coming to us, or we are going to them because we are expert in our field, so that uh, right, so the proper discussion can happen. So that is very, very important. So if you're not expert in what we are doing, I think we should delay any discussion. I think that is the most important aspect. And the second, of course, I think on the similar lines which I said in the introduction. So it should be strategic in nature. There should definitely be a need of what you are doing. Sometimes acqui-hires are happening right nowadays. So we celebrate saying acqui-hire has happened, but so not all the acquisition happens because what you are doing is great and the problem which you're solving is great and the platform is great. So sometimes people want good people, right? So companies want good people. So whatever you're doing doesn't matter. You just come join us. We know how to get the work done from you. So we have to be very, very careful about it, right? So you might get good titles, you might get good money, but your purpose and which, right, so Neelam ma'am was talking about. So that would get probably defeated when people are just looking at you as a talent. Right, so it is as good as doing a job. I think these two are kind of most important aspects. And yeah, so the third one is, right, it should just not be killing the competitions, right? Sometimes what happens, they have the similar product and you are also doing, and you are making a mark in the same product. They're saying, hey, so now let us have kind of monopoly. So taking our competitor also. So then you never know. So then because they already have the similar company, so now which one would be given more importance, right? So the one which was already with them, or you which you are getting entry, right? That would be more of political and bureaucratic stuff. So important is if you are good at what you're doing, all other things can be sorted out. Second, I said it should not be kind of acqui-hire when you believe in what you're solving is kind of worth solving and you have a technology to solve it. And I think the third, I said, you have to be careful. It's really strategic or there are other intentions. So yeah, those two points.
Thanks, Ankush. Three very interesting points you brought in, and I think the people listening in, the startup founders listening in, would find all of it very useful. So, with this, we heard the views of two startup founders. So, with this, I'll move to Shivangi to get a view from a investor and investment perspective. So, Shivangi, how do you work on an exit strategy which can be a win-win for all, both from a founder perspective as well as from an investor perspective? So, how do you make it a viable thing for both set of stakeholders?
Absolutely, that's a very good question, Devroop. I think to address this question, I would first like to set the preface that the venture investing, it's a game not of actually deploying the money, but it is actually a chase to get the best exit, which aligns with the interests of both the founders and the investors. While I think I spoke about this briefly, there's earlier also that there's a general notion in public equity markets that buy a blue chip company share and you hold on to it till you die. And I think this is the thesis that's advocated by many sterling investors as a foolproof route to increase one's wealth in the long term. So, I mean, to the surprise of everyone, this is actually the exact investment thesis that we also follow in this particular asset class, where we also advise our investors to stick on to the cap table of the investee companies, to double up on their investments till a point where either the company is acquired or there's an IPO, or to the point where there's a larger institutional investor who's willing to buy you out in the best case scenarios. I think the key factor in venture investing is flexibility in the time of the exit. For this flexibility, we need to, as an investor, we need to set the time horizon and an expected return on investment. So the investors also need to be decisive enough to pull out money as and when they reach their target return. Having said this, again, we'd like to advocate that investors stay on the cap table as long as possible. In this asset class, unlike public markets, the exit opportunities are very, very few and far between. And an investor needs to plan for it and be ready to capitalize on the opportunities when presented. So it's, I think, vital to understand that startup investments are not like a loan that will be repaid by fixed interest. Angel investors look at the ROI when they trade their stake for in a company for cash. This means that a successful exit will not happen overnight. It takes a lot of effort also on the part of the investors to work with their investee founders, if I may use the term, work towards wealth creation for both themselves and for the companies. So the exit, I think we've spoken about this, can be a financial exit when a VC buys you out, or say a larger PE firm buys you out, or a strategic exit where an acquisition takes place, which is a result of buying out the angel investor stake, or in a very, very worst case scenario, an acqui-hire exit where the startup is not seeming to be profitable, or we've seen cases where the founders have lost interest and they want to do other things, or as pointed out by one of my co-panelists, if there's a larger firm who's looking to hire talent and they feel that this is the investment that they could potentially make to acquire that talent. So we explore multiple routes, whether it is a merger, whether it's an equity swap with a larger company, to halt the further depletion of investor capital. So liquidation, IPO, and also family succession are also some of the more common exits that are seen. According to us, an ideal time to exit a startup would be when the business is registering high growth rates, gaining traction, while making substantial profits. Again, these are very, very broad parameters and would vary for each company. So an investor would simply need to consider the circumstances of the venture, the market scenario, the return of investment that they are expecting, which, given the risks involved with the asset class, would be much higher than, say, if I were to compare it to a public equities market, and accordingly make the decision. So there's no secret formula for exit. We wish there was. But what is certain is that angel investors need to be on an active lookout to make successful exits, yield maximum returns on their investment. They need to give up certain anchoring biases, and also, at times you may want to exit from what you see as your key opportunities at when your key investments when the right opportunity presents itself. So if I were to sum up my thoughts, I would say that successful exits may seem arbitrary, but they also require full-time efforts to find the right fit, involvement, the patience to gain the expected ROI. There are undoubtedly risks involved, but the right strategy and timely exit can be rewarding. So for startups in our portfolio, what we started doing is that we have a established managed exits desk, which, from the time we onboard a company onto our portfolio, we work very, very closely with the founders, not from an exit perspective because we invest at a very early stage, but we look at them through the growth journey, through subsequent rounds of funding, and we work towards scaling the companies that are on our portfolio. Because as the companies scale, it is commensurate with the wealth that is generated for our investors. So that is the goal that we work towards.
Sure. Thanks, Shivangi. You brought in a large number of learnings and best practices, and I'm sure the startup founders listening in would definitely benefit from it. So with this, I'll move to Rohit. Rohit, you have been an investor. You have been in this field for a large number of years, and you would have seen various exits. So there are multiple exit strategies which are possible. So based on your experience, which ones are best suited for startups, or is it different for different point of time type of startups, etc.? So according to you, what strategy is the best one?
Sure. So Devroop, I see four things at play here. I see capital at play. I see liquidity at play. I see market at play, and I see. Sorry. So is there a problem in my line?
No, Rohit, we can hear you.
Oh, sorry. Okay, I thought there was some feedback to me. So I'll repeat. I lost my chain of thought, but I'll just repeat it. So there are four things at play. There's capital at play, liquidity at play, market at play, and ownership at play. These four things, Devroop, to my mind, cause different combinations of selection possibilities that come together. Capital at play means the company and any startup needs capital all along the journey. It can be less or more, but the one thing is certain, it'll need capital along the way. And often this capital will be needed beyond its balance sheet, beyond its accruals. It will need it from outside. So capital for the purpose of growth, for the purpose of investments, for the purpose of further acquisitions, capital itself becomes the reason for capital raise. The second reason for capital raise, or what causes things to come in play, is liquidity. You've had your prior round of investors. Perhaps you don't need capital, but you need to create an exit for your prior round of investors. And this goes to one of the points which Ankush was saying, and I really, I loved, Ankush, by the way, loved the passion with which you're bringing your points out. I think for a founder, an exit isn't necessarily his or her exit. Actually, I share your passions, Ankush, completely. I think it should never be that. You should be in a journey as if you're in the journey forever. But there are other co-passengers who will board at one station and get off at the other station. And then there'll be different ones that'll board up at station B and get off at C. So as the founder, as the management team, as the CEO, a big part of liquidity management has to be that you can create a vibrant share ownership initiative, which can allow your co-passengers to onboard and offboard the train. And therefore liquidity planning for them is a very critical part of a successful founder. The third play is the play of market. And this drives a ton of things, but this comes in at a little later stage. The play of market is where you're hitting a ceiling. You've kind of, in your business model, you've hit a roadblock. Your business model, you've tapped out and you want to exit because of that. Or you haven't hit a roadblock, but there is a succession planning issue. And because there is no succession, well, then you would rather divest. It's time for you to now create generational wealth outside the business and manage that rather than keep running the business. So those are things which are related to maturity of the business. That's related to market at play. This also comes into very much where the ownership of the product roadmap can be completed by dominating it, by acquiring others who fit the whole jigsaw puzzle. So you would rather acquire or you would rather exit one or the other to complete your or somebody else's product roadmap in a much more accelerated way, in a much more dominant way. So depending on which way you are, either you're acquiring or you're exiting, but either of the situations is creating an exit or creating a liquidity. So that's the third. And the fourth is where you're totally floating the ownership. You're creating an all situation float, which is going in for an IPO. Now the stock is liquid, you've listed on a stock exchange, and that obviously comes at a very mature stage. So I'm kind of keeping that for the last. I think in the context of this conversation, Devroop, my 80-20 would be the ongoing capital raise. That's the most frequent event. That's the one thing founders need to be most aware of and be ahead of. You'll need many rounds of capital. You'll need it at many stages of capitalization. You will therefore have different investors who will suit different classes of your or different stages of your journey. And they will need to be given the flexibility to onboard and offboard you. And that is what the ongoing capital raises. So to my mind, a successful team would be working on an 80-20 basis on that. Everything else fits in the 20. Somebody wants to acquire you, or you want to acquire, is the 20%. You would at a certain stage of maturity get into a listing, that's in the 20. But in a simple Pareto 80-20, it's most vital for you to be ready for waves upon waves upon waves of capital raise. And I'm assuming that that's required, because if that's not required, then you're in a totally different business and this whole conversation is rather mute then. But I'm assuming that you need several waves of capital.
So thanks, Rohit. You brought in very interesting points about 4 different things at play and the importance of capital. So I'm sure the startup founders who are listening in would find it very useful. So with this, I'll request Neelam to come in. So Neelam, what should be the role of founders or promoters after exit? We earlier heard Ankush speak about it slightly briefly. So what do you see the role of founders or promoters after exit, and how do they continue to contribute to the growth of the firm which they had set up? So Neelam, over to you.
So, Devroop, this is a very important question. With dilution, or with the dilution of ownership, I would say, whether you do IPO or you do rounds of capital raising, the ownership of the company is going to get diluted from the founders. You know, at every stage as you raise capital, you are selling a portion of the company in a crude ways, right? And hence, by the time you reach to an IPO, most of the time the CEO's equity or the founder's equity in the business is 10-12%. I have not seen anywhere where it has exceeded 20%. That's also an extreme case where the founder had 20%, because at the IPO stage, people do cash out. Now, when you have that much less equity in the company and you've diluted, as an individual, some of the people feel, I made this company, I need to exit it now. Some other people have to call the shots. But in some cases, investors want the founders to continue. They want people who have invested in the company, want the founders to continue. And you get along with the dominant investors, you continue, right? But if you don't get along with them, and I see this after a year or two, the co-founders and the founders and promoters exit the business, and you bring in professionals to run the business. So far, we have not reached that stage in the large companies, but we saw it in case of Flipkart, right? We saw it in case of Myntra, we saw it in case of Flipkart, where the founders exited the business. They felt that it's best for them to sell all their stake or have very little stake and just not be operating CEOs. And that's also the right thing to do if that's what you want to do. And then move on in your life, in the journey you want to do. But I think it's very people dependent. It's very dependent on the situation. If you get an investor who you're not going to get along with, or it has been a hostile acquisition bid, somebody wants to acquire you and they make a bid. And we saw that in case of listed companies, right? When Mindtree was acquired by L&T a year or so ago, clearly the Mindtree promoters were not keen to sell it. But L&T was able to pick up dominant shares from the company and hence acquire the company, no matter what the founders wanted to stay on and continue. And then the whole management change happened, ownership change happened, and so on. Right? And that happens in listed companies even more than it happens in private companies. So It depends on you as a founder. Do you want to continue or not? If you plan to continue, then you should have stake in the business. Having equity 10, 12, 15, if possible, you should maintain it. And that gives you enough to have a say in the company. If you feel that the journey of the company is not completed, you raise capital, as Rohit pointed out, and even Saurabh pointed out, that you are in a situation where you want to create the next generation of the product and you need capital for it. You don't have the money to do it, or the early investors are the people who invested as seed money, or it was an incubation kind of an investment, and now they want to cash out and go somewhere else. So all those issues play on you. But if you feel that there is a journey ahead, and especially I've seen this in founders who are very technical, and they are needed to continue developing the next generation of the product, and hence they decide to stay on. But quite a few would, in fact, in India, I haven't seen this founders change so easily as you see in other countries. And they continue for some more time as they look at the next generation of the company to come in.
Sure. Thanks, Neelam. Very interesting perspective, very interesting view. I would also request the audience who are listening in, if you have any questions, anything that you would want to ask the experts, to put in your questions through this platform, and we will try to take in some questions at the end of the session. So with this, I'll once again come back to Saurabh. Saurabh, you've seen startup both in India and as well as in US. So is there any fundamental difference, or did you find any difference between these two places in terms of the approach towards exit? Now, both these countries are very large in terms of the startup ecosystem. So is there any difference? Is there any learning from one to another in terms of the whole exit scenario? Saurabh, you're on mute. We're unable to hear you.
I didn't understand. Okay, so I'm just saying that indeed there is a lot of difference. Here, if you would see, it is more collaborative environment, which you will find competitively more overseas, specifically in Valley, where founders are coming together. Not just it is not the requirement of the capital, it's not the requirement of any of the other cases, but they want to solve the bigger problems. Okay, and for that they come together. They see that okay, this particular platform of mine, when collaborated with the existing channel of some other company, would create a bigger impact for the ecosystem. So they kind of based on to the stage of the company, they get into acquisition deals or something like this. Okay, because it's pretty wise that the leadership remains unified in such a way where the company which is getting acquired holds a bigger position in the company who is acquiring them. So that kind of a relationship is happening more in overseas areas itself. In India, we will find more acqui-hire kind of a approach, where at the same time founders are not, they have a certain reluctance in India, because first of all, they see that the corporates in India might not share the same vision for the product which they have been working for last over a decade, or half a decade itself. So they have a trust problem while passing on their product to a corporate house or a larger corporate itself. So that is something which many Indian founders have seen a lot of reluctance in. There's a best deal when the founder retains the power and the decision making around the product, around the GTM, around other things. They kind of still feel comfortable in an acquisition deal offered by any larger corporates altogether. Third, it's that many of the people in India are kind of acquiring a product just to kill the competition. Okay, they're not hiring for creating a bigger impact or something like this. And you might see in recent cases of Byju's and other people, they just want to be the dominant player, and that's why like they are trying to kill the competition while going in that particular direction. So that is something which you will find as a difference altogether. It's more around the thought process which a founder carries, and or the ecosystem which they have seen in past or trying to build for the future. So that is, I think, is a key difference which I have experienced while my tenure in Silicon Valley and while I have been in India doing this stuff.
Sure. Thanks, Saurav. Interesting points you brought in, and I'm sure this is more of a best practice as well as learning for the startup founders and the whole startup ecosystem in India in terms of how do we collaborate more. So now I would request Ankush to come in. So Ankush, so apart from monetary consideration, so how important are the softer aspects like team or culture or the product synergy, etc., when one looks at an exit and an acquisition? So how important are these, how it's evaluated, etc.? So Ankush, over to you.
Yeah, very radical thinking. I don't think these things are important. Um, See, when two companies are talking, I'm sure these two companies have right. They have achieved something, and they have achieved something with definitely uh, great cultural values. And I don't think when there is a discussion about M&A, um, these values would be important. I'm assuming there would definitely be implicit and explicit values these companies have inculcated, and they reach that level, and where there one or other companies see the value in merging. And even if there are some cultural issues, and that can be sorted out. Um, when I was in corporate, and we used to kind of remember there are 6 key values, 7 key values, and they're almost the same, um, which are re-articulated differently and all that. But, and being in India, we are very, those values, I think we learn first and then the other things. So I don't think these things are very important. I think the important part is really be the best what you're doing. And I really liked, as Saurabh said in Valley, people believe in collaboration. So in India, we have one problem, including me, and I think I might be stereotyping, but my view it is. So we think we can do everything, right? So especially in the software, why should we acquire? Why should we join hand? We can also do. It's just matter of 1 week. So that right, this infatuations, right? So these things we have, if we get away with, we should be able to focus on what we are good at and what we have subscribed ourselves to. And thank you, Rohit. So I agree with you. So when I was little apprehensive about the exit, but I do understand. So we should have a vehicle so people would come and go. So the whole purpose, it should not just be one founder's purpose. The whole purpose should be met, and we should have a good kind of approach. Let people come in, and few people are good in coming at the seed stage. They mentor us to the founders, and then go, and the bigger investors would come in. So we should have a good inclusive path for everyone to kind of play a role. Thank you for articulating that. And to answer your question, Devroop, so the cultural values and all that, especially most of the Indians are very good at. I don't think those incorporate things are that important. In books and everything is important. I'm assuming those things are already there. Even if they're not there, can be sorted out when we are talking about the bigger purpose in life.
Sure. Thanks, Ankush, for your view. Different but important view. Also, I like you talking about that as an organization, we need to be good at something, we need to be expert at something, and that's something which is very important. And I'm sure the founders listening in would take that away, that whatever you're doing, whatever problem you're solving, be good at that, be great at that, and be an expert at that, and everything else probably will fall in place. So now I'll request Shivangi to come in. So Shivangi, you have looked at investments in different companies. So do you think exit strategies or approaches would be different based on the company, based on the type of industry or the type of startup or the type of product they're into? Would it be different based on all these aspects, or what's your experience? Shivangi, over to you.
Yeah, thank you, Devroop. That's actually a very interesting question because this kind of ties up with the whole diversification strategy that we also recommend to our investors. So, like to give you an idea, like as a sector agnostic platform, today our portfolio is across maybe 24, 25 sectors with companies, some of which are registered in India, some are registered across the globe. And I would say we're kind of evenly distributed between deep tech and non-tech. And having the experience of 170 strong portfolio, which has looked at either exits or secured next round of funding for about 70 of them, I think we do carry some collective wisdom, which I'd probably like to share with some of the founders here. And also, but I'll speak also from an investor's perspective to bring on the table maybe some thoughts on how an angel investor or an early stage investor looks at investing in companies. Some of them look at it from a mentoring perspective, and the others are pure financial investors who are looking at it from an ROI perspective in terms of it's a high risk asset class, so what is the ROI that they can expect. So while I think all of us generally know the wisdom of diversification and how the overall unsystematic risk in our portfolios can be mitigated, but very few understand the correlation between a portfolio of companies, which can give a misleading appearance of diversification. So this is actually where an overall risk increases and which actually can make exits difficult. So when I'm talking about exits here, I would not talk about a founder exiting, but I'm looking at an investor's exit from their investee company. I'd like to explain this with an example. So let's assume that you're an expert, say in healthcare, and you see golden opportunities amidst the current COVID-19 crisis to invest in growing startups catering to the sector in particular. You go on an investing spree over a period of 6 months and build a portfolio of about 10 companies catering to pharma, medical logistics, healthcare equipment. Now the problem arises that as and when, what we see is maybe when the virus loses its pace, which we hope it will soon, and the market focus shifts to other sectors such as hospitality and travel, there might be a bit of a issue in the investor's portfolio, not in the company, from a return perspective. The funds in healthcare sector may dry up. There's something that we look at, which is the flavor of the season. So the investor views also change on which is an upcoming sector to invest in, because the typical investment span for an early stage investment is about 4 to 5 years before we can actually see any kind of return materializing. So then the exits can become a challenge. As a financial exit can become a challenge. So even though you are diversified within the healthcare sector, you have a high correlation within your portfolio, and this can pose a problem. So coming to the point, the exit strategy begins on day one of the investment analysis and the portfolio building. So here a foresighted approach comes into play where you need to anticipate the sectors which are going to be at the right stage of their business cycle, maybe 2 or 3 years down the line. But again, having said that, this concept of diversification is different for different investors. So one is a sectoral approach. The other is, one can look at it, say, as a sector-focused mutual fund-based approach, where you're focusing on one sector. The next factor that we can consider is potential synergies between sectors and startups in your portfolio. So say certain sectors or startups need ancillary services or an external push to set the revenues flowing. For example, we recently invested as a MA in a cold chain logistics company, Celsius. What was interesting was that we connected them to our portfolio B2B, FMCG and pharma companies, which actually accelerated their reach within the market. So what the advantage of this portfolio approach is that for a founder also, your first customers can actually come from your investors portfolio. So this is where if an angel investor has built a gold standard portfolio which is kind of protected from market swings, opinions, self collaborating and sustaining, so that, when the opportunity arises, portfolio companies are future ready for a good financial exit. Now, this could either be by the way of an incoming investor when the company is ready to do the next round, or a potential M&A should there be a fitment with another company. So I think summing up, I will speak on behalf of venture investors. We thrive to look at the bigger picture while building our portfolio and actually set targets for our exits. It is this liberal mindset that allows us the flexibility to align our exits with market moves and investor traction. So, to conclude, I would like to say that every exit is unique on its own, but the process that precedes the exit is interrelated with the other investment decisions of your portfolio and also the timing that you are able to catch.
Sure. Thanks, Shivangi. You brought in different approaches, different methods, different processes. I think it was very interesting, very useful as well. So now I'll go to Rohit. Rohit, we have seen quite a few successful acquisitions in the past which created value, as well as we have seen acquisitions which have not really worked out, which eroded investor value. So what, according to you, makes an exit or an acquisition successful? What really works and what is it that which doesn't work? So Rohit, over to you.
Sure. Therefore, I think the first and foremost thing is timing. And timing causes broad misalignments between various stakeholders in an exit. There is management, there is founders, there are investors, there is team, there is market. Now, if timing is wrong and these people are not aligned right, that is itself one of the biggest challenges that happens. So I think the first and foremost thing is that the exit process, if I can use that phrase, that exit process has to be timed perfectly. And not only timed perfectly, it has to be managed in a way that it doesn't run ahead of you. Very often, actually, Devroop, this is such a critical thing. I have seen more exits where finally, whatever people may say, but if you really deconstruct those exits, you'll realize that somebody or the other wasn't happy, or somebody or the other felt they got slighted. And the reason is that as you get along the planning and the execution of an exit, the process runs ahead of you. The people who feel their objectives weren't taken care of, they were not on the steering committee which drove it, their rights in the shareholders agreements weren't respected. At the literally when the exit definitive documents are being drafted, there'll be people who will start at that time dropping anchor and refusing to move along with the others. So all those dimensions have happened. And actually, I'll be very candid with you. I've seen more exits with challenges than exits which are successful. It is actually true, at least from my vantage point. So now, therefore, there's 3 or 4, perhaps more things, 3 or 4, 5 things that I would really think are very, very vital. Number one is, and all these are kind of go after planning and putting the process in place. Number one is the business has to keep going on in a BAU mode, business as usual mode. That's very, very important. So whoever is called out in the exit team is certainly not somebody who needs to have the hands on the wheel. The hands on the wheel is a different team that's going on, and the team which is on the exit planning and management is a very different team. And some of the best examples are where there are more than one founder, so more than one co-founders in a business, and one of them along with one principal shareholder or one principal investor. That's a great combination. They carve out themselves as the exit team. So one of the co-founders and one of the principal investors tag team to create the whole exit management process. So keeping the rest of the business alive for a BAU. So that's the BAU and the special team. The next is capital or cash flow runway coming under stress during an exit is one of the worst things that can ever happen. And I can't tell you how many times we have seen it. And typically the reason it happens is that you often start looking at exits as also and it's true, exits are also linked to a capitalization event. So because the exit and the capitalization are coterminous, and you kind of planned it to be a 6-month thing and it becomes a 9-month thing or a 12-month thing, that stress that it causes in the system is just mind-numbing. It just completely drives you nuts. So that's a very critical part, having the runway. I think an upfront common minimum terms kind of alignment between all the stakeholders upfront, even before the process starts, is very important. It's almost like a signing up a constitution preamble, that we're getting into this for these reasons. This is what we expect out of it. And if this comes together, this is the must have. Everything else is a good to have. So that must have, which is the common minimum terms, is very, very vital. And it almost kind of gets signed in blood between every shareholder or stakeholder as the inter se between them, which takes them into the exit. So I'll kind of stop there, Devroop. There could be more, but in my mind, if these things come together well, and it's easier said than done, but if these things come together well, you can look at a good exit.
Sure. Thanks, Rohit. The very practical points, examples of what to do when you're driving an exit. What are the things which can probably make an exit more successful? So very practical points, Rohit, that you brought in. So with this, I'll move to Neelam. So Neelam, exits are often defined in terms of the returns which the promoters got or the returns which the investors got. So what, according to you, is a right return, or is there a right return at all? And is there something to look beyond money in terms of exit? Also, as a related question, after exit, how do you ensure that the business or the management or the operation that is not hampered, that continues, that comes in and delivers value? So Neelam, over to you.
So Devroop, great question. But I must say one thing. As a founder, as a promoter, once you decide to sell your business, you've decided that there is another investor who's going to take over, or you're going to do an IPO and then exit the business. I think you should let whoever takes over run the business the way they want to. You should not be interfering. So let's not think about you as a founder trying to define the future strategy when you're already exiting the business. Let the new team define what they want to do, especially when there is when the CEO exits. The CEO exit always happens, or the founder exit always happens. Either the investors and the founder do not agree on the next steps which the company should be taking. And in that situation, you see many of the founders leaving. And if they do leave at that stage, then let whoever won the battle or the politics, as Ankush said, in the boardroom, let them now decide how will they run the company. And I think that's a very important thing. Two, every time when we raise capital and every stage when we raise capital, or even when there is an IPO and as a founder you're continuing, there has to be a strategy on what will you do with the capital raised. It cannot be to write off bad debts in your books, because if all the money is going to clear the past, then the future isn't going to get anything, right? So never ever think I'm going to raise capital to clear the debt which is sitting on the books. That is not going to happen. And if you raise just that much money, which is going to write off what you had in your books or to pay off the earlier investors, it's not going to help your business. You're going to keep struggling to grow and then look at it and continue to think, what am I going to do? How am I going to raise capital? Where is the liquidity? And how do I go after the market, which is there outside with us? I think a word which I always use, and especially with very young startups, is patience. You cannot just have an idea today, product tomorrow, go to market third day, and then say, okay, I'm rolling, I've got my business happening. There has to be a patience to test what you have developed, ensure it works well, and then take it. I think one of the speakers before me, and I did write down, had written saying, you have to be doing something of very good quality, or what differentiates you, right? If something is differentiating you because of quality, or because it's more healthy, or because it is more efficient in cost saving, that intrinsic value doesn't go away, whether you've sold the business or you've kept the business. So that intrinsic value is sometimes not realized by the buyer, right? the uniqueness of the business is sometimes not realized by the buyer, and you actually land up giving it free of cost to the person who's acquiring the business. Obviously, the valuations are looking at what the future business can be of that company, and I'm sure those valuations take care of these intrinsic qualities of the business. Coming to your question, should the founders are they looking at exit for money? If the founder leaves the company, yes, he was looking for money. He was going to start something else. He's not any longer invested in the idea. He thinks he's going to do something else. He should quit. Let someone who believes this is going to continue to work take over, take the money and do something else. But if the founder is going to continue in the business, then he has raised money to invest in the business. So he's thinking about growth. He's thinking about the name of the company, the longevity of the company, and how am I going to be growing that company to be there for another 10 years, 15 years, or whatever it is. But do they get anything more than the money? I think it's the satisfaction of having created some business which is going to continue for many years to come. And that's where I feel many of the founders, when they talk about their earlier investments and earlier businesses, they look back and sometimes do say, I could have scaled it even more. But, there is a satisfaction that I created an enterprise. If somebody mentioned Mr. Ambani's name and said he doesn't exit, he's never thought of exit. True, but he has that satisfaction of having created an empire which he has created, and many people want to do that as founders too. So money is what you get, but the satisfaction is the second thing. And if there's a change in strategy, please lay your hands off and let the new management run it the way they should. I have one disagreement with Ankush's comment on, he said culture is not important. I think culture is extremely important. If the buying company, for example, if the buying company is not as aggressive as you have been as a startup, you will see talent leave, and good talent will leave first because they'll get jobs very quickly. Or you were a slow company and you get acquired by someone who says, okay, I want results every day, end of the day. Or you were a hands-off manager, you gave freedom to your team to work on various things. And now they get acquired by someone who was wanting reports and inputs to be given every day. That culture itself will have the exodus of the people who founded the company with you. And that's not a good thing to happen to an organization. So I think it plays a role on retention of talent. Good talent is the good talent and the best talent which leaves first. So, how to hold it for some more time so that the acquisition is successful is important to think through from cultural perspective.
Sure. Thanks, Neelam. Very interesting view, very useful view. You spoke about also you had a view around the culture part, which I also personally feel is critical, is important. So we would now take up some questions which have come in from the audience, from the viewers. And I would also request the audience, if you have any more questions, you can send those and we will try to have the experts respond. So, so we have someone who wants to know, wants to understand that how a startup should respond to an acquisition offer, and if the startup is founded with the purpose of reducing service cost, which otherwise is a hype thing, or maybe to generalize it, we can say if the startup is probably there in a market which is quite crowded and there is an acquisition offer. So how does an startup founder, startup promoter respond to an acquisition offer? So probably I'll have Ankush and Saurav respond to it. So Ankush, first you, and then we'll move to Saurabh. So how does how does a founder respond to an offer if there is an acquisition offer? Ankush, over to you.
Right. So I think what I do is I ask them, why you want to acquire and what good things they have seen in us, why we. So I think it's easy for anyone to answer why they want to acquire, and the second is why not our competitors. I think these two questions, and then if this question is about how we should respond, so that actually depends. Are you ready? So have you created enough IP or that moat as a startup? Are you too early uh, to get acquired? Or sometimes some companies even are okay, they want to acquire, but they say, okay, let us not acquire you, but we'll fund you and we'll watch you further. So that is something interesting I have recently learned, right? So now most of the companies have venture arms, not just M&A. They also invest uh, strategically. So if not ready to get acquired, and as even Rohit was saying, we need money almost every time, but yeah, the quantum might be different. So you might need money, and if you're not ready, you might explore the investing. And I've seen in our space, a lot of big companies have invested uh, in the companies. Maybe that time they're not, maybe either of the companies not pretty sure whether they should be merged or not, but they see the value and they want the strong partnership. And one aspect is kind of investing. Yeah, I think these are my thoughts.
So,
So
Saurav, your views.
Saurav,
Saurav,
just
Saurav,
read
your
the
views.
balanced questions also, which have come up on chat from the same
Yeah,
person,
I'm
trying to
just reading
clarify
side
the
by
question. Yeah.
yeah, I'm just reading side by side. Okay, so two things. One is what kind of a problem you are solving. Are you solving a problem which is there for the masses, which solves a which may be a lifestyle problem or something like that, or you're solving a deeper problem like saving someone's life or something like that. There are a lot of startups which works on very focused goals altogether. Now, coming to the pricing part, acquisition can actually boost you to provide a low cost services for masses. It happened to us. My last venture, which got acquired by Times, there it was a case that we were directly competing with a global institution who has a presence in almost like hope I'm audible is
Yes,
something a
Saurav,
network
you are.
issue.
Yes,
I'm
Saurav,
able
you
to
are.
see. Yeah. So I'm just saying that it happened to us in the past. We were having a price range for which we were serving our customer, and there was a global competitor which stepped in into the Indian market, and they slashed the prices to a very big extent. So as I mentioned, in India is a being a price sensitive market because customer would only trust when they use or subscribe to your product. So we went to a freemium model for a while, but we thought that in order to provide a kind of a model where we actually be able to sustain the company, okay, and still be on a lower side of the price range, we got it acquired with that motive itself, because we were not otherwise we won't be able to scale it well, and at the same time would face a challenge of competing with the this global leader, and at the same time our prices if would have been on a higher side itself, the market percentage would be much lower for us. So now this business is going to doing good. It has more than 56,000 plus businesses being running on that particular platform, which is indirectly serving almost like 80 million people. So see that depends on what kind of a acquisition offer is coming to your table, and at the same time how well you are making them negotiate with your terms. That is very much important, because many a times if you would see that that the price has to be low for a substantial amount of time, customers should be benefited out of it. That is the terms you can always put across to your acquiring company, or the corporate house which you are involved with. So I think these are a few of the things. This will actually boost your bandwidth to provide a more low cost services to to your customers if you are getting acquired altogether. So.
Thanks, Saurav. I think you brought in a very good perspective that it can actually bring in economies of scale at the acquisition. You might be able to provide service at a better price, better cost. So, so one question which I had, and I'll request Rohit and then Neelam to come in. So when I was talking about this session and the subject to people around, so one question which a lot of people had was around IPO as an exit strategy. And having seen a successful IPO very recently, and there are talks of quite a few IPOs coming up in this space. So do you see this as something which is going to be the norm going forward? And with that, would the whole strategy around exit change for startups? And so Rohit, your view and followed by Neelam's view.
Neelam, I would follow you.
Okay, so there is a lot of frothiness in the market. Everybody is very, very excited, especially after the 60,000 crore IPO of Zomato. People think, and we've had some very good IPOs in the last few months and quarters. So people think this is the time to do an IPO in India. In fact, I'm aware of many organizations who were looking at doing an IPO in US, and suddenly they've changed it and said they will do an IPO in India rather than going to US or any other part. And that is definitely happening. When do you do an IPO? Today, the market is hot for IPO. Everybody sees that. But is your organization ready for IPO? That's the first question one has to ask. Because there is a system and process which a company which is listed has to follow. For example, you would have to have your quarterly results published. Are you all capable of doing it? Do you have the processes in place? Because you'll have that much more scrutiny from the stock exchange as well as any regulator if you are in a regulated sector. And you will see that that kind of a scrutiny, many of the private companies don't need to go through. And hence, before an IPO, there's a whole lot of work on your financial accounting, on your CRM, on your supply chain management. You need to have those processes in place before you do an IPO. So let's not just think, here is a company, I was running it on the way I was, and now I can go ahead and just list it. What I also see on IPOs is many of the boards are getting reconstituted before the IPO because people want to see. Most of the boards today in startups are people who have invested in it. They're coming from your earlier investors. And as a result, when you are going for an IPO, the market wants to see who are the independent directors, who are the independent thinkers, who are guiding this firm, who are the advisors to this firm. And that's what restructuring is done from governance perspective also in some of them. So your readiness for IPO is very important before you jump into saying, I need to do an IPO. While the market is really where it is today, but I think, just pause and think before you do it.
Sure. Rohit.
Yeah, Devroop, the reason I request Neelam is nobody has better perspective than her. She's on the board of 2 listed companies and has been in the past as well. So I think by far very sharp and clear. I'll just add one point to Neelam. I think, I think market has a lot of capacity right now. GDP, market cap of listed companies to GDP ratio in the US is about 2 times, and in India it's about 1 time. We're just 100% equal to our GDP, and in the US it's about 2 times. So global capital is flush. Capital coming to India is not a surprise. The market macros are all favorable. So when everything is going right, the thing that worries me is that now what can go wrong, because things can only go one way. When everything is going perfect, then things can only go one way. So I think the frothiness term Neelam used is very true. There is a lot of frothiness. There's a lot of hubris. There's a lot of macro tailwinds. What I would, here is where I would pick the points which Ankush was saying, that there is so much of resilience and robustness in a business model that's needed, that if that lends itself to an IPO, that's a great outcome. And I'm not commenting on Zomato versus India Mart versus X versus Y versus Z. I think each company is a great company, but what drove the IPO? Why the IPO? Was the IPO a capital raising process? Was the IPO investor exit process? What drove the IPO? I think that, and this kind of goes back to the basics of the whole conversation we had today, Devroop. So I think approaching IPO with that headset is very important. How many of us know companies which have never done an IPO and are amongst the most wealthy companies on the planet? And by the way, philosophically, they would never do an IPO. They would never do an IPO. And they're very proud about it. The Wallenbergs in Germany, and you can go on and on and on down that list. So I think there are two schools of thoughts. I think irrespective of which school of thought you take, the key thing is if you're going in for an IPO, you're going with a very clear reason why. Is it float? Is it liquidity? Is it capital raise? Is it investors exit?
Sure. Thanks, Rohit, and thanks, Neelam. Those were great views, expert views coming in with very practical sense and example. So we have had a great discussion. We had a great session with experts coming in and putting in their view across a whole diverse set of points from an exit and acquisition perspective for startups. And I'm sure the viewers, listeners would have definitely benefited. With that, I would request Neelam to come in for her closing remarks. Over to you, Neelam.
Thank you, Devroop. I must thank you first for doing this session. You did one session earlier with us, and then we said, yes, that's how a session can go very well. So thanks bringing all of us together and having the discussions and questions being asked. I'd also like to thank all the panelists for being here. It was really interesting to listen to very different views. And this is a great platform because I know everybody is from a different location, and that helps us come together and give our thoughts. I want to thank the participants, and I hope all the participants got some learning. I think we all try to share our experiences with you. And if there are still more questions, you can always drop them to ASSOCHAM and we can look at it. But I think it was a good learning session and very, very well conducted. So thank you everyone for being on the call. Thank you.
Thank you.
Thanks everyone.
Thank you everyone.